Our next guest just raised his economic forecast today and now expects the economy will grow at a robust 3% this year. Bill Gross is the founder and co-chief investment officer of PIMCO. That's the world's biggest bond fund. Bill, thanks for joining us. You know,
Hi, Susie.
That's a very dramatic forecast. What's changed? You were just a short while ago expecting 1.5% growth for this year. Now 3%. Is it today's jobs report? Something else?
Well, I think that helps, Susie. To be fair, we do expect 1.5% to 2% for the first quarter and the first half. It's in the second half when housing starts begin to improve even from current levels, and then when the sequester and the fiscal drag, as economists call it, begins to lessen. And so it's a second half that has the 3% potential, but for the year in total, probably 2% as a whole.
Bill, nice to see you. You know, you've been a little bit uncomfortable, to put it charitably, with respect to the Fed's policy. How, if at all, do today's jobs number, in your view, change what the Fed will do with respect to interest rates and the bond purchasing, or what it ought to do?
I don't think it changes it much, Tyler. To be fair, all markets are moving based on central bank check writing. The Fed is writing $1 trillion worth of checks in this particular year if they continue their program. Will today's employment report change that forecast? I don't think so. The chairman and Janet Yellen and others have been pretty vocal in terms of the continuation of certainly the policy rate, the Fed funds rate at 25 basis points, and the continuation of this bond buying program, this mortgage buying program. So I don't think it changes it. They're looking at a target of 6.5% unemployment. We're at, 7.7, and so we've got a long ways to go.
Bill, let me ask you a little bit about stocks versus bonds. Everybody's been telling investors time to switch out of bonds and go into stocks. Now, I know you run this big bond fund, but do you agree with that strategy? And if people do that, what happens to bond prices?
Well, I think that all asset prices are artificially elevated. Let's be fair, that treasuries, the 5-year treasury at 90 basis points, which means 0.9%. It is certainly low in yield and high in price. To a certain extent, that flows through to other assets such as stocks and high yield bonds and so on. So we have an artificiality to all asset prices. I would say that bonds are not in a bear market. They've certainly gone up in yield over the past few weeks and down in price. But this is really a market of bonds as opposed to a bond market, Susie, and so an astute manager, hopefully PIMCO's in that category, can pick bonds in Mexico and Brazil and, perhaps even Italy and Spain, where yields are going down and prices up as opposed to vice versa.
Bill, in your always very interesting letter to shareholders or to investors this month, you write about irrational exuberance.
Yes.
And you say that on a scale of 1 to 10, asset prices are right now about a 6 on the irrational exuberance scale. What does that mean in terms of what investors should do with their money, or what should they expect in terms of returns from their money?
Thank you. That's a good question. I think what it means in terms of what they should expect is a return from bonds of, perhaps 3%, 4%, a return from stocks of perhaps 6 to 7. It simply means, rational temperance as opposed to irrational exuberance, which was the phrase in 1996, all the way back to Chairman Greenspan when he asked the question. I said we're at a 6 on a scale of 1 to 10 in terms of exuberance. That simply means that as stock prices move higher and that as risk spreads are compressed in terms of bond markets, that we should begin to be cautious. Don't look for an exit, but temper your enthusiasm with lower expectations and perhaps a more diversified and lower risk portfolio.
Well, Bill, we know we can always count on an exuberant conversation with you. Thank you so much. Have a great weekend.
Thank you both.
Bill Gross, founder and co-investment officer of PIMCO.